Self-assessment season is upon us, and if you are required to do so, you have until the 31st of January to complete and submit your tax return here in the UK for the previous tax year. One of the aspects of the self-assessment system that you should be aware of and maybe have faced in the past are HMRC inquiries and investigations into your tax returns. Now, in this video, we will cover what is a HMRC tax inquiry, what normally prompts an inquiry, and 3 steps you should take to reduce the risk of an inquiry. Before I get into today's video, be sure to hit that subscribe button as well as the notification bell to make sure you're kept up to date with all of our latest content. This really helps us to produce more helpful videos and to get you free quality advice from real qualified accountants. When you complete and submit your self-assessment tax return by the 31st of January every year, HMRC immediately processes your tax return and makes basic checks to ensure the accuracy of the calculations. HMRC now have a powerful and advanced computer system and software that does this for them. And with the push to digitisation and HMRC's Making Tax Digital initiative, they are becoming more efficient and can get access to information about you and your financial affairs from many different sources. So unless you hear otherwise from HMRC, you will pay any outstanding liability based on the figures shown in your self-assessment tax return, and this is what is known as a process now, check later system. To encourage compliance and honesty, HMRC's extensive inquiry powers are an essential element of the self-assessment tax system for them. The Taxes Management Act of 1970 gives HMRC the right to inquire into personal and trustee tax returns. This right applies to the original tax return and to any subsequent amendments to the return made by the taxpayer, and it applies in all cases. The term inquiry does not have a statutory definition and therefore carries its normal dictionary definition. In their inquiry manual, paragraph EMO 091, HMRC put forward the definition as seeking information, asking and questioning. Consequently, anything beyond a correction of an obvious error or omission is treated as an inquiry and must be dealt with by way of a formal notice of inquiry, which you would receive in the post. Before we continue with today's video, we're thrilled to be launching the Accounting and Tax Academy membership site early next year. We'll be posting downloadable resources, tax tutorials, and in-depth courses that you can't access anywhere else. And the best part is it's absolutely free to join. Head to the link in the description box below and register your interest today. The vast majority of inquiries begin because HMRC suspect that there is something wrong with your self-assessment tax return as detected by their advanced computer system and network. In other words, there is either something on the face of the return that gives cause for concern, or HMRC have information from other sources that conflicts with what is shown on the return. Nudge letters are often used by HMRC to prompt taxpayers to recheck an entry or the lack of an entry on a self-assessment return in a particular area. Nudge letters are not an inquiry in itself, but if you don't deal with the request or information on a nudge letter, the chances are HMRC will open a formal inquiry into your tax return. There is what's known as an inquiry window, which is basically a time limit HMRC have to open a formal inquiry. Let's suppose you complete your 2019-20 self-assessment tax return and submit it on the 31st of January 2021, the deadline date. Assuming HMRC received the return on the same date, then under the Taxes Management Act of 1970, they will have up to 12 months from this date to open an inquiry. There are circumstances where HMRC can open what is called a discovery assessment beyond this 12-month inquiry window, but we'll cover that in a later video. Be sure to click on the bell notification icon to get notified when we release this. There are generally 3 types of inquiries HMRC can open, namely an aspect inquiry, a random inquiry, and a full inquiry. An aspect inquiry relates to one or selected specific entries in your return. As long as it's handled well and honestly, an aspect inquiry is often swift and to the point. Random inquiries still happen. HMRC will select a number of random returns, not based on any risk factors, but are primarily designed to ensure that the inquiry system is working well and to send out a little bit of a message that they do actually check people's self-assessment returns. A full inquiry goes a bit deeper, and it is where HMRC seek to inquire into every aspect of your self-assessment return and to also test your overall financial affairs. Ordinarily, a HMRC inquiry should be nothing to worry about so long as you follow the steps in the next section. There are a number of steps and checks you can make to significantly reduce the event of any type of HMRC inquiry, but these are the three we recommend you focus on. Number one is get your self-assessment tax return drafted as early as possible, as so you or your accountant gets time to actually review the return objectively. Don't forget, from the 6th of April to the 31st of January, you have almost 9 months to prepare, complete and submit your return, so there is plenty of time. If something looks odd when you take a step back, then it gives you a chance to iron out any accidental and non-deliberate errors or omissions before submission, as so you are exercising reasonable care. Honest mistakes do happen, and HMRC do understand this, but you want to reduce the chances of an inquiry in the first place, so therefore take a little extra time and thus care. Number two is to use supplementary notes where appropriate. In your self-assessment tax return, HMRC provide blank boxes to add supplementary notes optionally. You can add text to provide additional useful information and explanations that can provide HMRC with some clarity and reduce any misinterpretation or misjudgment of your numbers that their computers could throw up. This is particularly useful if your affairs are somewhat more complex. For example, you have capital gains, properties, overseas income, or other types of complexities. And last but not least, be honest and don't deliberately misstate, fabricate or conceal material numbers just to save a bit of tax. Yes, there is a moral argument as to why some rich individuals and large organisations perhaps don't pay their fair share of taxes, but for most of us ordinary folk, this is something we cannot directly control, so therefore it's wise not to let this skew your judgment and legal obligation with your own tax affairs. If HMRC do launch an inquiry and dig deeper, their tax investigators are trained to unearth such intent through their questioning, and this could lead to a full-on inquiry. Your time and energy is then diverted away from your job, business and family, and quite frankly, you could be facing a heap of issues, not to mention potential heavy penalties, interest on underpaid tax, and in the absolute worst case scenario, a criminal investigation and proceedings against you. You'd rather sleep well at night with a clear conscience so you have the right mental energy and effort to do what you do the best. And on a final note, the law does allow taxpayers to organise their financial affairs in such a way as to minimise their liability to tax. This is what's known as tax avoidance, which, whilst acting within the strict letter of the law, is completely legal. Tax evasion, however, is strictly illegal, and HMRC have great powers to ensure that people acting outside the law face the consequences for their actions. We'll be going into more detail about tax avoidance versus tax evasion in a future video, so don't forget to click on that bell notification icon.